Good afternoon. Thank you for the introduction, and thank you everyone for dialing in this afternoon to discuss this interesting topic of the GST law. What I've done is put together a bunch of slides which you will be able to visualize on the screen. The way I've structured this is to talk a little bit about the GST legislative process, to talk about where we actually stand on the legislative process. Is the GST law actually coming in? Is April 17 a reality? I'm sure that's the first thing that crosses many of you in your mind, and that's something that I will touch upon. Thereafter, we'll go into through 4-5 key concepts which are relevant to the IT hardware sector, and then get into specific 4-5 key issues for the IT hardware sector with focus on the Make in India and manufacturing related issues that the sector is likely to expect or experience under GST. With that, if you may look at slide number 4, I've summarized where we really stand on the Constitution Bill, and in summary, the government is now awaiting to get the Constitution Bill passed in the upper house of Parliament, i.e. the Rajya Sabha. So the government has passed the Constitution Bill which requires the change in the Constitution for the GST, because please remember, today we have a VAT, which is a sales tax levy and levied by the states. We have a service tax and excise duty levied by the center, and that is, all of these powers emerge right from the Constitution. So when we're moving to a GST regime, we are looking at a paradigm shift in the legislative powers of both the center and the state, and that's the reason that the Constitution Bill amendment is the most critical one for the GST law to actually come in. So as things stand, the government has on many occasions stated that they're looking at placing the bill before the monsoon session of Parliament that's underway as we speak right now. It's a short session of Parliament, a 3 to 4 week one, and one needs to watch the space and watch on this topic very closely, because it all hedges upon whether the government gets the numbers in the Rajya Sabha and is able to pass the bill in the monsoon session. With that, one will expect the next stage to be that the GST bill will have to be ratified by 50% of the states. You'll also need a president assent, but most of the next set of steps are more procedural in nature, because the government has the numbers in more than 50% of the states, so one doesn't expect any surprises after the Constitution Bill goes through. So I will just talk a little bit about the numbers in the Rajya Sabha, and then talk to you all about what are the chances of an April 17 date. So the numbers as we speak are, the government needs 2/3 majority of the members present and voting, and we've got 245 members. So if we do have all members present, we will need about 164 to be voting in favor of the bill. The government, through their own party and through parties that have already stated that they will extend support, have about 157 seats, 157 members that will be voting for GST. So we need to wait and watch how the government is going to be able to cross the bar and be able to make the cross the last hurdle to be getting this GST bill through. There are different permutation combinations, different in various press reports that suggest that if a couple of the parties walk out, then the 2/3 of the present and voting will be easily met. I don't want to get into too much of political speculation here, but all that I can say is the suspense is only about 2 weeks away for us to see whether the bill gets passed through. And the next important point is that if the bill does get passed through in this session, the government is pretty much ready to enforce an April 1, 2017 date, and to ensure that that's the start date, because getting the bill passed thereafter would be a surprise to somebody like me, because I don't think the government would like to bring in an important tax reform closer to the end of the 5-year term of its tenure in the current 5-year regime. With that, I will move on to the salient features in the law, because what the government's also done is they've released the draft Model GST Law on June 14, 2016, and that also in terms of timing seems to be quite a reasonable timing to release this, because if they're looking at April 17, this means that one has about 9.5–10 months to examine this law and also to be engaged with the government to provide details. I think what is interesting to note is that this GST bill has a fair level of detail, and MATE's engagement with the government through different drafting committee members has suggested that the government has been having drafting committee meetings close to 75 to 80 meetings in the last 2 years, and this is meetings not only of the central government authorities but also the state authorities. So it's a mix of the central and state authorities who have put together this important draft model GST law, and therefore this represents three things. One, that it's not just a product of either the center or the states. It's a product that's arrived out of a lot of consensus between the center and states. Yes, as we understand, there may be few points that there's still a bit of disconnect between the center and states, but by and large, this is as detailed a draft that any of us could have expected. What this also then does is that enables most of us on the call to start dealing with the GST law and start dealing with this new law in terms of trying to understand the impact on our business operations and other impacts on the financial side as well as on the infrastructural side as to what kind of changes we need to make on our technology and reporting and the other details to be GST compliant on day one. So what are the concepts that have emerged in the GST law? The concepts that have emerged is it's a tax on supply of goods and services. So today we have VAT, which is a tax on sale of goods. You have a service tax, which is a tax on services. So in the IT sector, what is common as a debate is software supplied electronically, is it a sale of goods or is it a service taxable item? Invariably, there are transactions that have both the taxes. There are AMC contracts that have an element of goods as well as services. And what does happen in those cases is that the tax lands up being paid on more than 100 as the tax base. So you have a tax base of 100. Ideally, the tax should not be more than 100, but when there is a dual levy of both VAT and service tax, invariably the tax base lands up being more than 100, which is against the basic principle of indirect taxation. But under GST, the welcome change is that it's going to be a tax on supply. So at least, fortunately, we'll have no issue of a dual levy of tax or a double taxation. Be that as it may, I will get into a few other challenges and concepts around supply. But I just wanted to highlight that the model GST law not only talks about supply, it does very in detail lay down the principle of where is taxation of services and as well as good supplies. Is it in the origin state, destination state? Basically, the tax is a destination-based tax, and we have a fairly robust places supply rules that enable companies to determine as to where does one need to pay tax on a transaction. For product companies, life is far more simpler because we are already used to a local or an interstate tax. We already are aware of concepts of what is a sale that occasions a movement of goods from one state to another. Those aspects pretty much grandfather into GST and in fact only become more simple because what the GST law does, it takes away concepts like branch transfers, a CST sale at 2% with Form C. So all of the Form Fs, Form Cs would be a thing of the past. I'll again talk about that a little later. The next thing is that what is coming as a bit of a surprise is that there are valuation rules that have been brought in for domestic transactions. Now we need to watch how this will pan out, and I will cover that when I come to that slide. Some principles around time of supply, but most importantly, credit scheme is something that we all are going to look out for. And I can only highlight that this is the most critical part of GST that takes away a cascading effect of tax. Simply put, a trader today charges VAT on his sales, but he cannot claim a service tax credit on services received by him. And therefore, a trader paying, say, having a store in a mall cannot claim the credit of service tax on the rentals. So even though it's a B2B transaction, there is a break in chain and a tax which sort of gets built in because that guy, the trader will need to expense out the service tax. Conversely, a service provider, say a service provider doing cloud computing, purchases a server, he has to pay a VAT and he cannot claim a credit of that VAT either. So under the current scheme, you do have a break of chain in tax, and that's why we say the current indirect tax regime is flawed because you have a cascading effect of tax. You may have heard the statement, but I thought these two examples will enable you to understand the statement a little better. And what this therefore does is under GST is that we have a fairly more simpler credit scheme because you don't have to worry any longer, am I wearing a hat of a manufacturer or a trader or a service provider. Having said that, the draft does have some exclusions, particularly in relation to construction of services, in relation to motor vehicles. Without going into great level of detail there, one would hope that that sees some change as we progress in the journey in the run-up for GST, because we don't, in some sense, some of the aspects are old wine and new bottle, but we need to watch the space and be engaged with the government and try to get an even more simpler credit scheme for us to have a more ease of doing business and able to understand the tax implications easily. The next point that I thought of highlighting is about exporters. Yes, zero rated continues. So if you're exporting services from your BPO, from an STP unit or SEZ, today by and large you don't pay tax when you bill an overseas entity. That should remain as it is. There is some ambiguity around. Having said that, there's some ambiguity around the input side. As we are aware, STP units pay service tax and claim a refund. We expect that STPs and EOUs may continue to have to pay the taxes and claim a refund. But what is being looked out for is on the SEZ side, will there be an upfront exemption? Because like it's under the current law, the draft GST law is silent on that, and this is an area that one should be engaged with the government and encourage that an upfront exemption at least be provided to special economic zones, given that the far-reaching implication of a working capital related cost and tax credit block that could arise. With this, I thought of moving into some of the key concepts, and one of the key concepts is indeed the supply concept, and supply has just been defined to mean a supply of goods or services for a consideration. No difficulty in that. All of us fully understand that a transaction that is supply indeed should be for a consideration and be taxed. Having said that, the law proceeds to say that certain other supplies would be taxed despite there being no consideration. That's come in as a bit of a surprise to us. If you look at import of service, whether with or without a consideration will be a taxable supply. So this again brings up a question that I'd say I'm a multinational company. I've got services from my overseas arm, and that services are not paid for. If there are going to be these subjective questions that need to be answered, the tax authorities may say that, look, there's a cross charge, or you're receiving some sort of a marketing support from your overseas arm. There should be a value that is taxed. One that's going down a bit of a slippery slope and potential disputes around that. And also hopefully this provision gets sort of rolled back, because in any case, any tax paid on the input side is fully creditable, and it just goes through the entire B2B chain. So one would expect and hope that this import of service without a consideration is indeed modified. Supplies without a consideration, the government has actually notified some set of supplies which even without a consideration are deemed to be taxable, and I'm going to spend a few minutes on that in the next slide. Before that, it's worthwhile to note that transactions such as lease, works contract have been deemed to be services. So the good news is that for these transactions, the place of supply rules apply and not really the physical movement of the goods. I'm sure some of you may have that question in your mind, that why is Mahesh saying that it's good news, because if taxation of services has its own set of complications. I'll reserve that answer to that possible question in few minutes, but just proceeding further, it's relevant to note that in light of the revised supply definition of the ambit, taxation of software should become far more simpler. However, transactions like trademark licenses and others, while the due levy goes away, if there's an import without a consideration, there could be a potential dispute. What are the supplies that are without a consideration? One is transfer of assets to your own private use. I think those first 4 bullets are not something that worries me too much. What worries me is the last bullet. It says supply of goods and or services by a taxable person to another taxable person or a non-taxable person. So supply, let's ignore the word services for a moment. So supply of goods here effectively means a stock transfer from one state to another would get taxed under GST. Again, I don't see any problem in that, because what happens in a stock transfer is that you have a situation where say a company is manufacturing IT, say laptops in one state, they stock transfer goods to a distributor in another state. and therefore they charge an IGST on that transaction, and that particular tax that is charged then gets creditable in the next state. So in some sense, whenever there's a movement of goods, a GST tax continues at each stage, at the import stage, at the sales stage, or a stock transfer stage. So by and large, no surprises there. This is exactly what the industry expected around taxation of branch transfers. But what comes in as a bit of a surprise is, what is this supply of goods by a taxable person to a non-taxable person without a consideration? So is it that if I give 100 laptops to as a donation to a school, do I need to then treat that to be a supply? Fine, that seems to be one of the thinking that's emerging, because then what the government's trying to do is that they're saying that you can't claim all the credit on the input side and not have an output tax. But the larger difficulty or the situation of complexity that arises is where, say that you're supplying a laptop and you say speakers are free. Now in that case, would the speakers need to be valued and paid, be subjected to tax? I'm diverting from IT hardware, but let's say in apparel we see that buy 2 shirts, get the 3rd shirt free. Or is that, will that have one kind of treatment? And in the next situation is, what if we say buy 3 at the price of 2? I think clearly this debate of ambiguity and issues around what is this free supply is something that hopefully will be addressed and deleted going forward, because I'm not quite sure if this is going to bring in enough revenue for the government as against a potential cost of litigation and ambiguity around the same. Lastly, supply of services by a taxable person to another. I think given that our topic today is more on the IT hardware side, I'm just only going to raise one point, that does this cover a self-supply? So if I'm doing a manufacturing from one state, I have a marketing office in 5 states. When that marketing office gets fund transfers for me, because they are actually effectively, supplying like a marketing service to the head office, is there a billing that needs to be done by a branch to the head office? So just imagine the kind of compliances that will increase and potential working capital blockage that will happen in the event this is an interpretation. I would only say that one should watch this space and engage that we want supply of services to be deleted from this ambiguity, from a without a consideration kind of situation, as that creates potential disputes and litigation. The next point is on taxability of and registration. I think 9 lakhs is 10 lakhs is the threshold, and therefore for taxation, and 9 lakhs is when one needs to be registered. One needs to see how this will pan out, because there is some debate as to I think industry is asking for no taxation, or at least one authority administering them, whether turnover is less than 1.5 crores. That's what I read in the press this afternoon. There was a flash that that's what the states seem to be asking, and we need to watch this. But by and large, at least as per this draft law, once a person crosses 9 lakh threshold, he then needs to take a VAT or a GST registration and start charging tax on turnover beyond 10 lakh rupees. So again, from a product company, issues such as services and getting taxed at a state level does not arise, but I would like to highlight that today under service tax, one can have a centralized registration and pay tax for all services performed across the country. So even for an IT hardware company that has AMC revenue or other kind of support revenue for their clients across the country, it's just one registration that's enough. There's one tax assessment, one return, and so on and so forth. But under GST, each and every fixed establishment of an organization will require a registration in that state. So what is a fixed establishment? I've just clicked on the link, and the definition is before you. It effectively means a place which is characterized by sufficient degree of permanence and suitable structure in terms of human and technical resources to supply or receive services. So any office of an organization that is across the country, even if it is an office just to receive services like a renting service, even that would qualify to be a fixed establishment. So all that I would like to highlight here is that for product companies having service revenue, which more often than not is quite limited, but for that revenue stream, one needs to be prepared to see an important change of taxation effectively at a state level and warranting state-wise registration and state-wise compliances as well. Moving on, what is an interstate and intrastate supply? An interstate supply is a supply that, again, there are two principles, one for goods and the other for services. For goods, where the location and supply are in different states, and for services as well, why this phrase is used that where the location and place of supply is at different states. For goods, it's easy to understand that if the goods get shipped from A location and go to B state, from A state to B state, it becomes an interstate supply. If it is shipped within the same state, it is an intrastate supply. But the complexity is far, far more for a service provider, because in a service provider, important concepts of location of supplier of service and location of recipient of service emerge. So if we have an office in a particular state as a service provider and providing, say, IT call center services to a telecom company. So there's an IT company in Bangalore providing call center services to a telecom company based in Gurgaon. What should be the location that the service, the GST is deemed to be provided from? Because let's assume that the company actually has 5 offices across the country from where these services are indeed performed. Does it mean that they have to take 5 registrations? Does it mean that, let's say it's a 100 crore contract in this example? Do they need to split that 100 into 5 states? It's something that on a first brush does suggest that each state is a fixed establishment, probably at its own accord. But the larger question then arises that if the service has been done to support 15 circles of the telecom company, does this then mean that the IT company has to raise it on the 15 states? And therefore, are we looking at 5 into 15 and therefore potentially 75 permutation combinations? I'm not going to go into that in great depth because our topic today is more on the product side. But all that I can tell you is that there is a lot to worry if you're doing any service revenue, and there's a lot to be concerned to take the right tax position, because any incorrect tax position is not only is going to result in tax demand, say, in another state, and also it would probably result in the original state where you paid the money, where the party just refuses to, the state just refuses to give you the money back. What becomes relevant to product companies is taxation of warranty and AMCs, because these services are it's very unlikely that it's directly provided by the seller. Invariably, you have an authorized service provider or a third party in between, and therefore one needs to look at the crisscross transactions comprehensively to be able to determine the tax position. I did talk about the valuation rules earlier, and I just said that there is domestic valuation rules that have been brought in. Simply put, these rules are quite similar in language to the customs valuation rules, and they do talk about royalties and licenses being added for supply of goods, subsidies in any form being added. In this particular situation, what happens is that one needs to look at transactions between parties, that is there any other interchange of money that happens, and does that have to be loaded onto the transaction value is something that we need to watch out for. I can only tell you that this is, and the other aspect is that aspect relating to supply of transactions between related parties will be subject to further scrutiny, is something that concerns industry, because related parties transactions often happen. But the next question goes back to the fundamental question I raised earlier, that is there any real merit in having a detailed valuation provision for B2B transactions? Because even if, say, a company has a logistics arm under a legal entity, a different legal entity, and they qualify to be related parties, and there is a view that no, that value should be on an arm's length value. Any which way, if there's additional GST that's charged, the recipient entity, being a B2B entity, is more often than not going to be able to claim the credit. So that being the case, why would we need to have this detailed rules? Is something that industry seems to have gone back in different forums to the authorities and saying that we would like the valuation rules to be kept simple, and to keep it simple only to the extent that where there's a consideration on a transaction, look no further. And industry doesn't have a problem that when there is some other flow in the form of money coming in, which is in relation to the sale of goods or other services, that needs to be loaded. That's okay. But to have it in this wide manner is something that concerns the industry. Moving forward, the credit utilization sheet that you see has a lot of crisscross. Simply put, a central GST can be offset against a central GST, a state GST can be offset against a state GST, and an IGST is sort of a joker in the pack where you could either utilize it freely on the input side or freely on the output side. I wouldn't want to get into great detail on this slide, it can take a fair bit of time, but all that I can say is that the credit utilization and credit kitties need to be monitored state-wise. So you can't say, look, I've got pan-India operations, I will offset the credit that I've built in the state of Maharashtra against the credit I've built in the state of Tamil Nadu. Input tax credits, I did talk about it, that the rules now effectively enable wider crisscross availment of credit, because I don't need to worry, am I a trader or a service provider or vice versa. It's all just quite simple that as long as I'm a B2B party, I should be able to claim credit. Having said that, what is being looked out for is certain restrictions that exist in the Model GST law, and more importantly, what industry is looking for is a seamless transition into GST, whatever may be the date, that if there is tax suffered goods, that credit should be able to be moved into GST, and that's what the industry is being lobbying for. The law does bring out some fairly detailed transition provisions, and we welcome that. We do think it's about 80-90% clear in terms of the transition provisions, but there's some small ambiguity still for goods that are subjected to an excise duty and are held in stock in a supply chain. With that, I think I would like to just highlight here that, I've highlighted some issues, and since you have the slides, I'm not going to repeat them, that some aspects of credits of cess, how do they get grandfathered, credit of taxes that are inbuilt into a cost of a product, how do they get grandfathered, what happens to job work related credit is another area that we need to look out for further clarity. Input service distribution, very quickly, if an head office is incurring a service cost, this cost will have a GST, that GST will need to be attributed to a pan-India and different operations across the country, and that can be distributed, quote unquote, under the IST mechanism. Few other provisions. The law does talk about migration of the registrations into the new law. Reporting norms and compliance calendar is coming out of the business process documents. Of course, we need to watch the space for a little bit more detail, but there are a lot of documents for all of us to actually read and start understanding the impact. And I think it's no longer easy for us to actually say, hey, I don't have any detail. I keep hearing about GST, but where do I make a start? I think, to be very fair with the government, the level of detail that has been brought about in the draft Model GST law, as well as the process documents, does indeed suggest that there is enough of data available for each one of us to start understanding the impact, not only from a financial side, but also on a procedural and compliance side. So the next part is, pending refund claims, what happens? The law also is expanding these advanced ruling provisions. So all that I can say is that the Model GST law has the best of both the state and the central state and the service tax laws, and I think to that extent we need to welcome some of this. I would urge that all of us understand the impact a little individually, because there will indeed be some areas that have some issues, and to come back to MATE and to other industry bodies and to the government, and importantly to talk about what kind of changes we think are required for an ease of doing business. So in a one slide, if somebody were to ask me, oh, is GST, how does it impact manufacturing sector, the trading sector, and services sector, I would say that manufacturing is by and large similar, other than for some of the products that have a lower excise duty rate. I'm going to talk about that. But I think what we need to note is that manufacturing companies are used to having an excise compliance as well as a VAT compliance. So they're used to two credit chains continuing. So for them, it's not going to be such a paradigm shift. But what it does is that in some sense I was tempted to put in equal with a thumbs up, because it takes away all product taxation issues around interstate sales like Form C transactions and Form F transactions as well. There will be an increased rate of GST, but potentially a possible pricing impact, because one does read that the rate of tax would be close to about 18%. If that comes through, let's remember that for white goods today, the rate is 12.5% as of excise and about a 14.5% on the VAT side. What one needs to note there is that considering the excise duties on the factory price, typically a product has a 23 to 23.5%, so 18% is welcome. But for IT products, by and large, most states have a VAT rate of 5 to 5.5%, and the excise is at 12.5%. So 12.5% on a factory price would be about 9%, and you add that to the VAT, we had 14 to 14.5%. So the short point I want to make here is that it's probably important for the IT industry to be engaged and to go back to the government and say there is a merit rate being talked about. The R&R report, which was the Chief Economic Advisor's report on what the rate of GST ought to be, suggests that that rate should be about 12%. Why shouldn't ITA products be there? Because this is an industry that continues to need an impetus from the government because of the penetration that we currently have. While it may be good on mobile phones, we've got a lot of ground to cover on tablets and laptops and other networking equipments, and this is not only at the back of a Make in India, but it's also at the back of the government's other pet project of a Digital India. So basically we should probably think of going in for a lower rate of GST for ITA products. Coming to the trading sector, if somebody is importing goods, at least now the CVD, which was paid earlier, was sort of a customs duty tax. It is now an import GST, which is offsettable against an output GST. The next is, and therefore in some sense for a trader, there's a simple credit chain that continues. The next point on warehousing is relevant both for manufacturing and trading companies, that do I really need to have so many stock points and warehouses across the country, because no longer is there going to be an interstate 2% tax. So one can expect that one should be relooking at the logistics decisions made in the past to revisit and to optimize that going forward. Possible additional compliance is something that we need to look at. But on the services side, all that I can add here is that the very fact that services will get taxed at a state level, and India is just one country obviously, and we in the past have never been entering into service contracts separately for each and every state. Going forward, how is this going to be dealt with and addressed is something that worries me a little bit, to say the least, and I would think there's a lot of ground to cover for service companies to be GST compliant, and that's why I've been a little critical here. But I think that from service companies it is a bit of a thumbs down in terms of them having to do a fairly paradigm shift in the way they do business, whether it's on the contracting side, whether it's on the billing side, and whether it's on their compliances on a regular basis. And last but not the least, if the services continue at the 18% rate that's talked about, are we talking about 15 going up to 18? I would think so, and therefore potentially that can have a negative impact. But if you look at it at a macro level, some of the products, the pricing should go down, and for some services it may just go up. Greater depth of detail, but I thought it useful to still conclude that for services, our assessment at BMR is that, and MATE is that, we do feel that that sector is a bit more impacted than the others. ICT, I think a few points that we thought of highlighting is that there's no concept of a demanufacture going forward. Size law, there's invariably a debate that am I doing a repacking, does it amount to manufacture, some of those things hopefully will be a thing of the past. There are Make in India initiatives that have been come about for mobile phones, tablets, and some consumer premises equipment, as it's been called, CPE, networking equipment, routers, set-top boxes, that the government in the recent budget has brought about a very interesting method to ensure that there's a Make in India advantage for manufacturers of these products. How will these get grandfathered into GST is something that we need to look out for. Of us who are in excise-free zones or VAT zones that are getting some incentives, without getting into great level of detail, you need to really look into your package of incentives and see how that can be honored in the GST regime, because simply having an upfront exemption under GST does not help at all, because if GST is exempt on the first chain, but the second and the third chain and the supply chain is going to be taxed fully, then it's in fact counterproductive to have an exemption. So one needs to look at one needs to renegotiate. I talked about the SEZ scheme a little earlier, that it does merit representation to say that SEZ should enjoy an upfront exemption going forward. And there's no clarity on the lower rate of products for ITA products. I did talk about the merits that exist for representing that. Specific impact on AMCs and warranties is more in light of the place of supply rules. So 3-4 issues before I go into the Q&A. One of the issue is that, for the mobile phones, you have a Make in India scheme, which is on a 1% rate. I mentioned it as 2 because it's a 1 plus 1% NCCD, and tablets at a 2% rate. In a nutshell, today a mobile phone that's imported has a 12.5% rate, but one that's manufactured has effectively, an effective 2% rate. Now, what happens to this benefit going forward is something that we need to be engaged and look out for, because clearly companies are making very large decisions to make investments in India for manufacture, but hopefully some of these schemes continue under GST as well. Though I think the larger issue the government is coming back is, tell me the best method, and I don't think consensus has emerged as to what should be the best method be to grandfather these benefits. Merit rate for ITA products, I did explain that the excise rate is about 12.5% on an MRP basis, which is about 8.5%, and that's why we've arrived at a 13% number, which is the effective rate today for an ITA product. Actually, it goes up to 13 to 14 is how I would like you to read it. And coupled with some exemptions, I think one needs to see what happens under GST and debate amongst ourselves, is there real merit for us to be asking for the lower rate? We shouldn't just be asking it for the sake of it, though I personally think that there is a merit for ITA products to be at a lower rate. SEZs, the representation that we've gathered from our key members and some of you on the call is that should be continued to be zero rated on the input side, and this is something that we need to look out for because the draft law is silent on this. Warranty and post-warranty supplies, whether it is in warranty and post-warranty, all that I can say without going into too much of detail because it gets very complicated is, let's say a manufacturing company sells the goods from state A to 10 different states. The spare parts for those operations are very unlikely to be sent only from state A, because for support operations to be meaningfully met, these parts need to be stocked in 10 states, and the issue then arises that if those parts have a GST, how does the credit that is being paid on the warranty and AMC parts, how does one liquidate? I won't go into great level of detail, but I can only say that this is a large area of concern, and hopefully this has clear guidelines to address the ambiguity. The last slide I had was that, I think the representation that we received from some of you is that the supply needs to be narrowed down a little bit, particularly around import of service without a consideration, as well as that clause 5 that I talked about, because that can result in fair level of dispute and litigation, which is quite avoidable. So that's what I had for my end. I think I've met my time, which was allocated about 42 to 45 minutes to me. I'll be happy to take any questions that you have and address the same. Okay, I've got a few questions here. Let me just go up. I'll read out the question and give you the answer. What is the scope of GST in the case of free supply? Do we require to take a registration across the country? I think that you need to realize that where you have parts in each and every state, please be prepared that you would need to take a registration for each warehouse that you're paying, that you're going to stock the parts at. But the larger question then comes is that what happens to the part supply that happens to the end customer Obviously, there shouldn't be a tax again because he's paying you nothing for a warranty supply. He's already paid you an original purchase price. But then what happens to the credit that exists on those parts? I don't have a definitive answer. I can say just be engaged with the government because that's what we are, to try and ensure that there's no leakage of tax credit because I have pan-India support operations. As it is, the question next is, as it is a law, can we expect it to create more, ambiguity on vendors? I think let's remember that I think the government's intention is not to create an ambiguity but to sort it out. And I would therefore urge that as members we should go back with our specific issues and where there are ambiguities to try to get that addressed. But the only hitch that I see in this particular process of, even with the government with all good intentions, if they want to address the concerns, taxation of service at a state level is something that is here to stay, and therefore our issues around that are not going to be very easily solvable. So pardon me for being a little pessimistic there, but I'm being a little realistic, to be honest, that for a state level taxation of service, I think those issues will not really get addressed, and we'll have to figure out a way to keep it as simple as possible, but it cannot be eliminated. How does GST help the logistics sector? Clearly, logistics sector will have two set of, I would put there the thumbs up and down. The positives is that when a logistics charge is on a supplier, service tax is today charged. Many suppliers cannot claim credit unless they're a manufacturer. Going forward, the good news is all supplier of a logistics service, as long as it is a B2B service, should be able to be creditable in the hands of the recipient of the service. That's point A. Point B is that these logistics companies have operations literally in all states across the country, and therefore we can expect a fairly higher level of compliance and potential issues to determine where to pay tax that may arise. In GST, will every sale of goods be called a supply? Yes, every sale of goods will be a supply, and every sale of services is a supply as well. I think another one is a very important one, that asking me to comment on the future of the state and central tax authority. I think that's the most contentious issue right now, because clearly there's a huge army of tax authorities, and rightly so, because it's state tax, for example, is VAT constitutes almost 60 to 70% of state revenues. These authorities first and foremost need to anyway do past assessments. None of us on this call, I would imagine, are up to date on our audit till say June or July 15, 2016. So they will have that backlog to deal with. But I think the larger question that has little ambiguity in terms of the answer, and I'm sorry I won't be able to answer that, is because that's still being discussed and debated, that who will administer you? If you're a manufacturer with a 50 crore turnover, is it that only the central authority should walk in and do your tax assessment? Because at the end of the day, there's one element that's a central GST and the other that's state. So I don't think one will like to give up the power to administer you, but this is an area that we need to watch out for. I can only tell you that I'll be very surprised if there's lesser need than what there is today for a meaningful tax administration, because under GST we can expect the taxation supply chain to continue and more credit related verifications need to be done. So I would think that if I'm a tax professional or a tax inspector or officer, I can only tell you that both of us have busy days coming ahead, and I think that therefore these authorities will only need to ramp up to be able to do a meaningful tax administration. So is there a transfer pricing implication on domestic? Yes, there is a transfer pricing implication in some sense, because two aspects on transfer pricing. One is that the law says that related party transactions need to be valued. The other is that any transaction that you're receiving from an overseas entity, without a consideration, you need to pay tax. So one needs to be careful, because it's quite natural for us to say in a transfer pricing report that, hey, my pricing is at arm's length. In fact, it is lower than the arm's length, and therefore my income tax is lower, because the objective is to demonstrate a lower income tax that you have paid, and the tax authorities may say, hey, it's undervalued. But the indirect tax always has the flip objective, and we need to therefore watch how the valuation rules will finally pan out. I have spent some time earlier, so I won't repeat that again. Administration, really not sure who's going to administer which authority. I only read like the 1.5 crore and below would now potentially just have one authority administering them. We need to again watch that. So what is the difference in IGST, CGST and SGST? The full form of a CGST and SGST is a central GST and a state GST respectively, and IGST is an integrated GST. Simply put, if I'm buying a laptop for 100,000 rupees at a mall right next to my office now in Bangalore, that in addition to 100,000 there would be a CGST and a SGST. The total of 18% is likely to be split evenly between these two elements, and therefore you have a 9,000 and a 9,000 that applies on the local billing that that particular distributor has to me when I walk into the store. If he sells the goods to another reseller in another state, all that he will have to do is charge an IGST in that case, and that would mean that the credit chain continues to state B, and therefore IGST and CGST, SGST is the framework that was debated for at least a couple of years, and I think the consensus has emerged that as long as we have tax on every supply, that way any potential misuse of no tax getting reported or sale not getting reported will be done away with. What happens if a service company procures marketing material in different state while it has only registration? Can it take? So that's the point, that if you have marketing offices, you obviously have a rent there, you have a telecom, and then you also have advertising services like you talked about. I think it's a little unclear, but my personal view is that the self-supply clause in Rule 5 or Clause 5 does have a mischief in it, but the good thing about that is that at least in those cases we can say that the marketing office is doing work at the account of the head office, and therefore a tax should be charged and a credit should be available in that chain. Do I foresee any change in the exports getting taxed? No, I don't foresee a change per se, that exports remain non-taxable. Then the next question is that is Make in India exemption for mobile applicable to GST? Like I said earlier, the intention of the government is to make it long term. I really think it's going to be fairly difficult because, and even the government has said so, that we would like to be WTO compliant. We would like to have, no disparity per se. But I think I would like to take that question offline with that particular the person who's raised the question. I can only say this is an area that is still being examined, though they intended to continue. But there are fundamental hurdles whether it can continue at all. Does the whole Rule 6 have, which has a bunch of reversals, is it going to be relevant? To a limited extent it will be relevant only when you're providing an exempt service. Today if you're a manufacturer and you have trading as well, then you need to do a proportionate reversal on the trading revenue. That will go away, and therefore Rule 6 should be a little bit more simpler, though I did mention in my earlier slides that this Rule 6, this aspect will need to look at in terms of its scope. In case of a telecom operator, they are governed under electronic license. There could be more than one state. So here I think that it's fair to say that one will need to charge tax based possibly where the contract recipient located. And anyway, the ISD provision, which is an input service distribution provision, is a self-policing mechanism. So in that transaction that there's a call center billing to a telecom company in Gurgaon, let's stick to 100 crore for the period, the 18 crore that's get bills to Gurgaon, what happens to that 18 crore? Does that get transferred? Yes, it should be transferred to the 10 states. And that should be more a responsibility on the recipient of the service rather than the service provider himself, because how does the service provider guess and get the accurate split back end? So I would think that please be ready to prepare state-wise accounts, and you will have to deal with this at a state level. That's what I had from my end. I'll be happy to take any other questions that you have. So I would like to, in this case, okay, I think I've got two more questions, but I also want to, before that, I would like to highlight that in a nutshell, for a business, there are three buckets of, wow, there are more than three. Okay, there are one. There's more than, the impact areas can be summarized into saying, I need to do a financial impact analysis, an operational impact analysis, and an infrastructural impact analysis. When I say financial, what is the impact on pricing? What is the impact on working capital? What is the impact on rate change? That's one bucket. Operational, do I need to relook at my warehousing strategy? That's the next question I have as well. Simply put, I would just say that going forward under GST, the ideal situation is to ignore taxes, have your warehouses in as many states that you actually require to have them from a business perspective. Nothing more, nothing less, because you don't have this 2% tax to keep looking and worrying about. You just do warehousing, which makes business sense, and that should be by and large good enough to get you home. Infrastructure is to do changes around the IT systems, around how the invoices need to look, how the reports need to look like, and this is something that you need to start working really soon, because whenever I spend time with companies, so when we get down to this topic, they literally are baffled by the size and scale of the GST changes that are required, and also the fact that we are in July end right now. Effectively from August to April 1, we're only talking about 7-8 months. Is that really enough is something that we can always ask ourselves, but I think to be fair, the government has given us a fair level of detail, and it is quite possible, and we are already engaged with some companies to actually understand the impact based on the first draft law. If we take registration in a state and receive supply in another state locally, will credit be available? Like I said, this whole thing about transfer of credit from one state to another is a little ambiguous. It will take a lot of time to explain, but I think it's fair to say that stock transfers or like a self-supply of service concept should enable encashment of a credit. If not that, which is more what is more favored by the industry rather than a self-supply, is to have an IST transfer credit. So if I'm a plant, again in state of Bangalore in Karnataka, and I have marketing offices in 5 locations, I receive input services invoices there. Rather than me getting a refund, we should be representing for a simple method where the credit that's built up in the different states get transferred to the head office, given the final outward supply has happened from the head office and taxed therein.